What if I told you that within the next few weeks, silver could begin a price movement so explosive that seasoned investors with decades of experience won't believe what they're seeing? What if the math behind this move is so extreme that silver, currently trading around 70 cents, could realistically hit four digits, not in 10 years, not in 5 years, but potentially within months? The warning bells are ringing louder than ever. Shanghai silver is already trading at a 10% premium over Western markets. Physical demand from Asia is stripping shelves bare. And a 60-year pattern, one that took 6 decades to form, is finally triggering its explosive phase. But here's what makes this moment truly unprecedented. The people who've been predicting this for years, the so-called metal heads, are about to be shocked by the scale of what's coming. Even they don't understand the magnitude of the very thing they've been calling for. So the question isn't whether you're late to silver. The question is, are you prepared for what happens when paper markets can no longer mask the physical shortage? Let's start with something concrete. Numbers don't lie. And the math here is absolutely staggering. Right now, gold is trading around $4,500 per ounce. Now, historically, silver has traded at various ratios to gold, but let's use the 10-to-1 ratio as a benchmark. At a 10-to-1 gold to silver ratio, with gold at $4,500, silver needs to be at $450 per ounce. Stop and think about that for a moment. Silver at $450. That's nearly 6 times higher than current prices. But wait, it gets more interesting. The ratio that silver is actually being pulled out of the ground at, it's not 10-to-1, it's 6.9-to-1. The Earth itself is telling us that silver is rarer than the market currently prices it. And here's where things get really wild. In supply shortage scenarios, markets don't stop at historical norms. They overshoot, way overshoot. We could see temporary spikes that push silver to a 3-to-1 ratio versus gold. If gold hits $10,000 in such an environment, which is increasingly likely given our parabolic debt situation, silver at 3-to-1 means $3,133 per ounce. Let that sink in. $3,300 for a single ounce of silver. To put this in perspective, a standard 100-ounce bar at these prices would be worth $333,000. The 1,000-ounce futures bars, that's $3.3 million. The 32-kilogram industrial bars that dealers are already posting pictures of, we're talking about multi-million-dollar price tags per bar. Now, before you think this sounds too good to be true, let me show you what's happening right now in real time that proves this shortage is already underway. Pay very close attention to this because it's one of the most important leading indicators we have. Shanghai silver is currently trading at nearly 10% above the COMEX and LBMA prices. Let me explain why this matters. When Shanghai trades at a premium, it means one thing. Physical buyers in Asia are willing to pay significantly more than the paper price in Western markets to get actual metal in their hands. This is not speculation. This is not futures contracts. This is cash and carry, physical demand. And it's not just happening in silver. The same premium dynamics are showing up in platinum and gold. But silver's premium is the most extreme, which tells us something critical. The real shortage is in silver. The Chinese and Indians who are buying right now, they don't want contracts. They don't want promises. They want the metal. And here's the problem for the paper markets. You cannot print the metal. The metal doesn't exist. For decades, Americans and Western investors accepted contracts as good as gold. Paper promises were treated the same as physical metal. But that's not how Asia operates. When they buy, they want delivery. And every ounce they take delivery of is one less ounce available in the system. This isn't the same market it was in 2005 when the United States dominated precious metals demand. The game has gone global, and the United States isn't even leading anymore. The massive demand coming out of Asia is structural, not speculative. These buyers represent billions of people with a cultural affinity for precious metals spanning thousands of years. Here's something most people don't understand about market patterns. The bigger the pattern, the more explosive the move. What we're looking at right now is a 60-year setup. 60 years. Let that time frame sink in. From 1964 all the way through 2024, silver was building the left side of this pattern, creating higher lows, establishing a massive base. And now we're in the melt-up phase. Think about this logically. A pattern that took 60 years to set up isn't going to resolve itself in 2 weeks. It's not going to be over in a month. We're talking about a move that could run for several months, maybe longer, as it reaches toward its targets. The first major target sits at $90.50. The primary target, $333 per ounce. And remember, these are just the technical targets based on the pattern itself. They don't account for fundamental supply-demand dynamics, industrial demand growth, or monetary system failures. What makes this melt-up phase so unique is that it represents maybe 5 to 10% of the total time the pattern took to form. but this is where you'll see the vast majority of the gains. This is where the compression unwinds. This is where decades of suppressed price discovery happens all at once. And right now, we're in the sweetest part of this move. But here's what even experienced precious metals investors are missing about this setup, and it could cost them the opportunity of a lifetime. This might sound counterintuitive, but stay with me. Even the people who have been stacking silver for years, the ones who've been predicting this move, the ones who called the bottom and stayed long, even they don't fully grasp what's about to happen. You're seeing veteran chartists and longtime precious metals advocates starting to claim that the move is too disorderly or that there must be a major setback coming. They're going to sit in disbelief while the most unique phase in silver's modern history unfolds. Why? Because they're still thinking in terms of the old market structure. They're still looking at monthly and quarterly charts expecting traditional pullbacks. They're still applying normal market psychology to an abnormal situation. But here's what's actually happening on the lower time frames. Silver is providing perfectly tradable continuation patterns on the daily and 4-hour charts. What looks like a vertical melt-up on the macro time frame is actually a structured, trending market on shorter time frames. There are entry points, there are risk management opportunities, there are technical levels that can be used for position building. The trades are still there for those who know how to find them. From the daily chart perspective, we're not in some parabolic blow-off top. We're in a normal uptrend with higher highs and higher lows, offering multiple opportunities to add to positions with controlled risk. Now let's talk about something that makes silver completely different from gold: industrial demand. Silver isn't just money. It's not just a store of value. It's one of the most critical industrial metals on the planet. Solar panels, they need silver. Every single panel requires silver for its conductivity properties. And as the world pushes toward renewable energy, solar panel production is exploding. Electrification, silver. Electric vehicles use significantly more silver than traditional cars. 5G infrastructure, silver. Consumer electronics, silver. Medical applications, silver. Yes, gold is conductive. Yes, you could theoretically use gold in these applications, but you're not going to spend 3 times the price when silver does the job just as well. The economics don't make sense. This creates a unique situation. Investment demand and industrial demand are competing for the same finite supply. And unlike gold, where most of the gold ever mined still exists above ground, silver gets consumed. It's used in industrial applications where recovery isn't economical. It disappears from the available supply permanently. Not enough mines are being developed to meet this growing demand. The lead time to bring new silver production online is measured in years, not months. And even if mining companies wanted to dramatically increase production, the geology simply doesn't support it. We are heading into a supply deficit, and the market hasn't priced this in yet. And if you think that's concerning, wait until you hear what's happening behind the scenes in the monetary system itself. Here's the part that turns this from a compelling investment opportunity into a potential crisis. The Federal Reserve is losing control of the yield curve. In the last easing cycle, what happened? Rates were supposed to come down, but market rates went higher instead. And we're seeing the exact same thing happen right now. The Fed cuts rates, and longer-term yields go up anyway. Why does this matter for silver? Because the entire game of gold and silver suppression over the past decades has been about one thing: allowing the U.S. Treasury to borrow unlimited amounts of money. Think about the mechanics here. If gold and silver prices were allowed to reflect the true debasement of fiat currency, it would signal to the world that the dollar is in trouble. It would make it harder for the Treasury to find buyers for its debt. It would raise borrowing costs at a time when the national debt is already spiraling out of control. So gold and silver had to be suppressed. They had to be managed. The paper markets, the futures markets, the COMEX, the LBMA, these became tools for price management rather than price discovery. But here's the mathematical reality that can't be escaped. The money doesn't exist to pay back the debt. It doesn't exist to even pay the debt service without printing more money. And when they print more money, they dilute what's already in existence. They will dilute to oblivion. There is no other option available to them. And as investors around the world start to sense this monetization, they're going to dump treasuries. That rotation is already beginning. Global capital is moving out of assets that can default and into assets that cannot. Of all the markets that could break first, silver is the most likely candidate. Why? Because silver is the smallest market and the most suppressed. The concentrated short positions in silver are staggering. The leverage in the paper markets is extreme, and the physical supply is tight. When silver fails to deliver, and it will fail to deliver, that failure will immediately spill over into gold. The same institutions, the same bullion banks, the same counterparties are involved in both markets. Here's the likely timeline. Silver fails to deliver. Within 24 hours, gold has the same problem. Within 72 hours, the entire precious metals derivative complex is dysfunctional. Markets may not even be open at that point. This isn't fear-mongering. This is the logical conclusion of a system built on leverage, paper promises, and insufficient physical backing. Every ounce of physical silver removed from the system by Asian buyers, by industrial users, by stackers who take delivery, each one tightens the noose on this derivative structure. So knowing all this, what should you actually do? And more importantly, when should you consider taking profits? The gold to silver ratio is your roadmap for this entire move. Right now, we've broken through the 60s, we're in the 50s. This is major confirmation that the compression is underway. As we move toward the 10-to-1 ratio, that's when you start to thin your silver positions, not sell everything, thin. Begin taking profits gradually, begin rotating some exposure into gold, into producing assets, into the companies that mine these metals. Why? Because history shows us that silver tends to outperform dramatically on the way up, but gold holds value better in the volatile periods. The 10-to-1 ratio isn't the top. Remember, we could spike to 6.9 or even 3-to-1 temporarily, but it's where you begin to de-risk. At current gold prices of around $4,500, a 10-to-1 ratio puts silver at $450. But as this unfolds, gold isn't going to stay at $4,500. The same forces driving silver higher are driving gold higher. A more realistic scenario has gold pushing towards $7,500 or even $10,000 during this melt-up phase. At $7,500 gold and a 10-to-1 ratio, silver is at $750. Even at these levels, people are saying it's too expensive, I missed it. But compared to the 333 technical target and the potential overshoot to 4 digits, $750 isn't expensive at all. This is the opportunity to think in terms of multiples, not percentages. A move from $77 to $750 is nearly 10x. From $77 to $3,000, that's almost 40x. If you're thinking about selling silver already, you're missing the point entirely. The best is yet to come. The juiciest phase, the phase where the real wealth transfer happens, is just beginning. We haven't even hit the first major technical target yet. The gold-silver ratio compression has barely started. The supply shortage is only now becoming visible to mainstream markets. Everything that made you buy silver in the first place, the monetary debasement, the currency crisis, the debt spiral, the industrial demand growth, all of these factors are accelerating, not diminishing. Conservative estimates put us at $750. Realistic scenarios based on historical ratio compressions put us at 4-digit silver. Extreme but possible scenarios based on 3-to-1 ratios put us above $3,000. And unlike crypto, unlike stocks, unlike bonds, unlike real estate in many markets, silver has something unique. It cannot be printed. It cannot be created by decree. It cannot be diluted by central banks, and it cannot default. When you hold physical silver, you hold it without counterparty risk. You don't need anyone's permission to transfer it. You don't need anyone's blockchain, anyone's system, anyone's approval. You can dig a hole in the ground, put it there, and it will be there when you come back. It won't get smaller, it won't get lighter, it won't disappear, it won't be eroded. This is real, tangible, elemental wealth that has been recognized as such for thousands of years across every human civilization. Every market move has skeptics saying, this time is different. Usually, they're wrong. Markets do tend to rhyme with history, but here's the thing. Sometimes it actually is different. We've never had global debt levels like this. We've never had central bank balance sheets this bloated. We've never had this many dollars in existence competing for the same finite amount of metal. We've never had industrial demand for silver at these levels. We've never had Asian physical demand at this scale. The crypto community thinks they invented explosive price moves and generational wealth creation. But gold and silver did all of this in 1980. The difference is, in 1980, it was largely a Western phenomenon. The Hunt brothers, American investors, European money. This time, it's the entire world. 3 billion people in Asia with cultural affinity for precious metals and growing wealth. Industrial demand from the global technology revolution. Central banks buying gold at record levels, sovereign wealth funds diversifying from dollars. The float, the amount of available silver for investment purposes, is astonishingly small compared to the amount of global capital that could flow into it. Here's the uncomfortable truth. Windows like this don't stay open forever. Right now, you can still buy physical silver relatively close to spot price. You can still find inventory. You can still get delivery in reasonable timeframes. But that's changing rapidly. Premiums are rising. Dealers are having trouble sourcing inventory. Mints are rationing products. And when the broader public catches on, when this moves from the precious metals community into mainstream consciousness, the stampede will be violent. At that point, it won't matter what the spot price says. Physical metal will trade at whatever premium the market will bear. We saw this in March 2020 during the COVID panic. We saw it in the 1970s. We'll see it again, but this time the premiums could be even more extreme because the shortage is structural, not temporary. This isn't about timing the perfect entry or exit. This is about positioning yourself for a multi-decade structural shift in the monetary system. This is about being on the right side of the greatest wealth transfer in modern history. The 60-year pattern is triggering, the melt-up phase has begun, the physical shortage is becoming undeniable, the monetary system is breaking down in real time. You don't have years to prepare, you might not even have months. The signal coming from Shanghai, from the gold-silver ratio, from the price action itself, it's all saying the same thing. The window is measured in weeks, not months. So the question isn't whether silver is going higher. The math, the technicals, the fundamentals, and the monetary backdrop all confirm it is. The question is, will you be positioned when the paper markets finally break and the true price discovery begins? Thank you for watching. If this analysis has opened your eyes to what's coming in the silver market, please share this video with others who need to see it. Subscribe to our channel and activate the bell icon so you don't miss our coverage as this historic move unfolds. The best is yet to come. The time to prepare is now. See you in the next video.